Well, the profitability does have prediction for the long-run returns, but only for smaller companies. For companies with less than $100 million in sales, the companies with negative profits have historically underperformed by quite a bit relative to those with positive profits at the time of the IPO. But for the companies with more than $100 million in sales, and Lyft is certainly in that category, profitability doesn't predict the long-run returns.
So when you're taking a look, Jay, at Lyft and how it priced and then how it traded in its very, very early days, what was your take in terms of how that pricing was and whether or not investors were really reaching and have been reaching for this sort of growth?
Well, it's certainly the case that Lyft is being valued with very optimistic assumptions about the future in mind. But that was also true with Facebook and Google and Apple, not to mention Microsoft and many other companies that went on to a lot of success. What I have found for companies that had a hot IPO, where the offer price was raised to above the file price range, as was the case with Lyft, that for the next 6 months, whether the stock goes up or down, it has relatively little predictive power for the longer run. And in fact, those that declined in the next 6 months actually did better than those that went up in the first 6 months.
Yeah, you actually said a 22% gain in the next 2.5 years. So even longer term isn't that much longer term. I mean, Leslie, I think when we were discussing Lyft and as we look out to the other unicorns in the pipeline, a key difference between now and some of the other ones that the professor had mentioned when they went public during the boom is that these companies today are longer. They have a longer operating history. They've already gone to the VC market several times. I mean, these are much bigger companies with a history of operations.
They do, and they have the same investors that invest in the public market investing in them privately. I mean, one of Lyft's biggest investors ahead of its IPO was Fidelity. So one would think that in these private valuations and all the discussions that center around valuing a company privately, they should be somewhat similar to what you're going to see in the public market. Now, not perfect because you get one investor as opposed to a collective group of investors in the public market that you get to see. But some of those same discussions should be happening privately. And that's something we didn't see in the 1990s where you had those crossover investors like you do today.